It's everyone's worst nightmare. Imagine it's 4:30 on a Friday and you get the call that nobody expects. I'm sorry to tell you that your position has been eliminated. With this one sentence, your entire life flips upside down. Anger, frustration, anxiety, and shock overcome your emotions as you attempt to process the unfortunate reality that you will be without an income without any fault of your own. A layoff. While most financial shocks affect only those deeply tied to Wall Street, layoffs are different. They are considered the knockout punch in bear markets, a pain that trickles down from stock price to real life. While everyone is worried about inflation, falling markets, and energy, we have been lucky enough to avoid unemployment. Despite recent bad times, the labor market has been tight and finding a job has been easy, but over the past few months, the situation has taken a turn for the worst. Layoffs are on the rise and an unthinkable situation is developing as we approach a critical phase of this massive downturn. Tesla, Spotify, Netflix, Coinbase, Redfin, CVS, Uber, the list goes on and on. Dozens of companies are announcing massive layoffs and many more are freezing hiring. As earnings fail to live up to expectations, CEOs begin to fear what many have been predicting for months now. A dark cloud hangs over the economy and the rain is finally beginning to trickle down. In today's video, we look at the data and analyze how bad this will really get. Is this another 2008-like scenario coming right at us? We start off with this chart. We can see that right now layoffs are on the rise. For most of 2021, tech layoffs were essentially non-existent. They simply did not happen. Layoffs.fyi is a website that tracks every layoff announcement made in the tech sector. As you can see, starting in February, we got a light bump, and since then the numbers have just kept rising. With over 16,000 employees let go in June, the situation is approaching dangerously high levels, almost reaching the numbers we saw in April of 2020 when the initial shock of the pandemic overtook the markets and tech layoffs reached 22,000. But this chart doesn't fully explain the situation. You see, while layoffs have been on the rise and it's concerning, the overall labor market appears to remain strong. Unemployment as of the recent report is at near all-time lows. As of June 2020, it sits at 3.6%, indicating that things are great for now. But before you get too comfortable, you have to understand an important fact about unemployment. It lags recessions severely. For example, if we look at the 1981 recession, which I choose because it was a period of time where we had a lot of inflation and an energy crisis, the Dow peaked in March of 1981 and didn't bottom out until July of 1982. That's 14 months of slow panic in the markets. Now you would think that unemployment was fast to react to this obvious recession that will go down in history as one of the worst, but the stats say otherwise. When the market began its move down in March, the unemployment numbers didn't really react until about November of 1981. By that time, the Dow had already plummeted 15%, and when it bottomed out in July, unemployment continued to rise to 11% in December and wouldn't come back down to pre-recession levels until June of 1984, which was long after the market had made its recovery and surpassed the previous pre-recession highs. In summary, what I'm trying to say is that market turbulence takes a lot of time before bad earnings trickle down to job losses. Once they do though, they tend to be sticky, creating job loss long after the initial stock market shock. So yes, unemployment is still at record lows, but these recent layoff announcements are a concern as they could be the start of a snowball that could easily turn into an avalanche. What makes this crisis worse is that people are losing jobs, but the inflation level remains high for now. As of the latest report, it came in at a mind-boggling 9.1%, yet the Federal Reserve has decided to keep rates at historically low levels despite this fact. In the early 80s, when we were dealing with a similar issue, however, the Fed was fighting inflation with equally high rates. There has never been a time in history where the spread between the risk-free rate and the inflation rate is so ridiculously high. And that situation makes this time very different. As I will explain, this fact brings even more uncertainty and danger to the markets. It creates the potential for a Fed-induced economic shock. It's a theory that claims the Fed will overreact to tame inflation, and in turn, we will get one of the worst unemployment disasters in this country's history, along with high inflation. Now, before I explain, take a moment to hit that like and subscribe button if you're enjoying the content thus far. Now back to this theory. You see, this recent inflation report caught a lot of people by surprise. It came in at 9.1%, which blew out the theory that inflation had peaked in May. Now the Fed is confused, but ultimately it will be forced to be much more aggressive in order to tame this wild inflation. We know from the Fed's very own research that tightening cycles bring unemployment up. For example, this paper published by the New York Federal Reserve examined 14 monetary tightening cycles since 1955, and what they found is that 11 of the 14 resulted in an increase in unemployment. Now this is the part of the video where I'm going to go a bit deep on this report, but I'll try to make it as simple and as entertaining as possible. The reason it's important is that I think the Fed is using this methodology to predict how bad things are going to get, and this in turn will be the mistake of the decade. Before I get into it, I first need you to understand that we are already in a tightening cycle. The Fed is raising rates, and how much they raise is essentially what every economist and trader is trying to guess. If you knew when the Fed would stop tightening and reverse course, you could easily make millions of dollars, as the markets almost always respond positively to Fed U-turns. And we know the Fed usually U-turns when it looks like unemployment is getting a bit out of hand. This also coincides with a dip in inflation. No jobs, no demand, no price pressure. So what does this have to do with the report? Well, it turns out you can reliably estimate the change in unemployment following a Fed tightening cycle by looking at something called the 10-3 spread. This is the difference between the 10-year Treasury and the 3-month Treasury. When the Fed U-turns and the spread is positive percentage-wise, you see something magical happen. Remember earlier how I said 11 of the 14 tightening cycles resulted in an increase in unemployment? Well, the 3 that were outliers, where unemployment didn't increase, have all occurred when the spread was positive. In fact, as the spread gets more and more negative, the impact on unemployment gets worse and worse. It's my opinion and the IMF's that Jerome Powell wants to push unemployment to 5%. Right now, it's at 3.6%. That means if we look at the current spread, which is at positive 0.52%, we still have a bit of tightening to do. The Fed will likely push rates higher and higher until we see that spread percentage fall back close to that 0 to negative 0.5% mark. That way, when the Fed reverses, the unemployment rate should only rise by 1 to 3%. But here's the thing, with inflation at 9.1%, the belief is that despite a rapid rise in rates and that spread falling below 0, it still won't be enough to tame inflation. Many think that we'll need a Paul Volcker style bump to stop double-digit inflation from raging, and if we get that, this spread is going well below negative 0.5. It's going to be somewhere down here, and if that happens, the unemployment numbers are going way up, much more than anticipated. Now, of course, this is no guarantee, and we know past results don't always materialize, but regardless, it's evidence that the Fed isn't close to done. They're going to keep pushing until something breaks. At the end of the day, to tame inflation, you need to destroy demand, and of course, when you do that, you ultimately cause an increase in unemployment. The hope is that we can find a happy medium between taming inflation and destroying the economy. The truth is, there isn't a playbook to explain how to do this. On top of this, the Federal Reserve exists within a political system that is currently fighting a proxy war with Russia and increasingly China. Policymakers are aware and leveraging financial policy, especially specifics related to the strength of the dollar, to aid in this fight. Officials like Jay Powell are well aware of this financial weapon that he has complete control over. Raising rates and selectively bailing out allied countries through swap lines isn't out of the realm of possibility. The weaponization of the dollar has always been a topic of conversation, and now we may be seeing its full strength put on display. Hopefully, the tightening cycle doesn't get out of hand and mass layoffs don't become a problem. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed it.